Today, I want to talk about how an EX Citadel employee just exposed the massive fraud going on at Citadel Securities. I also want to explain exactly how the current banking crisis is going to impact both Citadel and the AMC squeeze as well. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, InvestorTurf posted this article that says exposed, insider secrets of Citadel Securities' rigged game revealed by an ex-engineer. He said you won't believe what they're doing behind closed doors. So it says here that a former engineer at Citadel Securities, one of the world's leading financial institutions, has come forward to reveal a manipulative trading game that insiders are playing. It says this game could be leaving many retail investors out in the cold, and the engineer's insights have provided a peek into the opaque world of high-frequency trading. This engineer himself, Patrick, said the game is not fair and it never has been. He said individual investors, even when operating in a swarm, are destined to lose. How do I know? Because I helped design the game. And it says this insider, so EX Citadel employee, aka one of those engineers that I spoke about a few weeks ago, has made startling allegations that the game is rigged by insiders. And these insiders at Citadel are wielding their influence to manipulate the markets to their advantage. Now, the reason why I said this is important a few weeks ago is because Citadel doesn't have typical investors or typical people that graduated with, say, an economics degree. Citadel's employees don't understand financial regulations. Hey, they probably don't even know what the SIPC or the DTCC or the SEC or FINRA even really stand for. Citadel employees actually graduated with degrees in engineering or computer science and spend all day coding computer programs. They don't spend all day researching and trading stocks. They're effectively just glorified IT tech guys. These employees at Citadel don't actually invest in and trade stocks, they just simply debug computer programs and fix any problems going on with those algorithms. And therefore these employees have never really known exactly how to blow the whistle because they didn't know that what they were doing was actually illegal. But this ex-insider or ex-engineer has obviously caught on. And it says the revelation of this rigged game is causing a significant stir in financial circles, as many retail investors are now questioning the fairness and transparency of the markets. And it says the recent divulgence of a former engineer at Citadel Securities has exposed several malpractices carried out by the company and other high-frequency trading firms that grant them an unfair upper hand in the market. And it says the post also illuminates how the firm wields its market power to manipulate the market in its favour, creating artificial liquidity or effectively artificially suppressing the price of a specific security, thus facilitating easier execution of trades at the desired price. And in response to the allegations, obviously Citadel Securities has denied any wrongdoing and has maintained that they have robust risk management processes in place to ensure the integrity of its trading activities. But obviously it's not the first time that Citadel has been accused of engaging in manipulative trading practices. And finally it says the whistleblowers like this Patrick guy serve as a beacon of hope in the murky world of high frequency trading, and their courage must be celebrated and importantly protected. Now I really do hope that this Patrick guy has gone directly to the SEC or to FINRA or maybe to the Department of Justice or the FBI or somebody that will actually take action. We know by now that obviously the SEC does side with Citadel and therefore the SEC basically won't do anything to actually crack down on this manipulation. But at the same time, whistleblowers do still serve a very important role, and I do hope this Patrick guy has gone to the very tippy top of the structure. But what is interesting is the fact that Citadel Securities' manipulative advantage may soon be running out. Also guys, be sure to join me over on Moomoo, the sponsor of today's video, using the link in the description below. You can currently get up to a whopping 17 free stocks, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomoo is very, very easy to use. They've got tons of technical indicators and advanced charting tools. And with Moomoo, you can also get free 24/7 customer support, and you can also trade around the clock with the full extended trading hours. As the average ape tweeted, he said, "My take on the AMC Threshold Situation." He said in the past they've used complicated loopholes like shuffling the position to another fund 13 days later to reset the count. And he said we've seen that before, but now for some reason nobody has or wants to take that burden on because liquidity is running thin. Now obviously we know with what's currently going on in the market, none of these banks or trading platforms or market makers would be stupid enough to take on this giant liability. With liquidity in these major banks running thin and basically everybody pulling their deposits from these financial institutions, nobody wants to take on billions of dollars, if not even potentially trillions of dollars in synthetic shorts. And therefore right now, whoever it is, whether it's Citadel or whether it's another market maker or hedge fund that holds these shorts, basically can't get rid of them. And that's why AMC continues to stay on this threshold securities list, and actually why the numbers of failed to delivers actually continue to increase. As StockSense Frank tweeted, he said, here's a summary of AMC's failed to delivers. And he said the average number of FTDs per day for February is 3.9 million FTDs. And we can obviously see that through 2022 and 2023, these FTDs have been going out of control, getting larger and larger every single day and every single month. I think it's going to be really interesting to see just how many FTDs we have for the second half of February and for the first half of March as well, as AMC is still on the threshold securities list. And now the reason why this is important and why it ties in specifically to exactly what's going on right now is because of this tweet from Kristen. She said the former Layman Brothers CEO, Richard Fuld, ran out of time as he tried to explain to a congressional panel the role naked short sellers played in Layman's collapse. She said there were reportedly more than 32 million counterfeit shares in the company sold, and in 2008 the line of questioning was on track, but it's clear that when it got to counterfeit shares there was little understanding or knowledge by anyone on the congressional committee of just how big the naked shorting problem was. Basically, Richard Fuld is saying that even back in 2008, synthetic shorting was a big problem, and it's part of what caused these major institutions to fail. Therefore, it wouldn't surprise me if many of these market makers or hedge funds are again continuing to synthetically short these companies and these banks that are currently failing right now, like Signature Bank, Silicon Valley Bank, and potentially more over the coming week. But obviously, because of what's currently going on in the market with the very thin liquidity and the fact that none of these market makers want to take on a suicide position, it's very, very difficult to shift these synthetic shorts. Now, you may have seen that actually Bank of America are also struggling, and this is also very important because Credit Suisse works solely with Bank of America. But let's speak about BofA first. So I found this very interesting thread that goes through bank by bank and compares the unrealized losses to the common equity of each bank, aka that shareholder value or the effective equity capital of the bank. Now, obviously, the main problem that Silicon Valley Bank had is the fact they had $15 billion in unrealized losses and only $12 billion in shareholder company equity. So obviously they had even more losses or unrealized losses than they did company value. Now we can see that actually Charles Schwab also have a very high ratio or percentage of unrealized losses to shareholder company value. It's not quite 128% like we saw in Silicon Valley Bank, but it is 89%. But actually some of these smaller banks that we're also seeing starting to experience bank runs, like First Republic Bank, have a much smaller unrealized loss to company value percentage of only 36%. Again, we've also got Signature Bank, which did actually go under, that only had a ratio of 4% of unrealized losses to common equity value. Now, Bank of America, however, actually have a very high ratio of unrealized losses to common equity, with $108 billion of losses to $174 billion of equity, a ratio of 62%. And therefore, if Bank of America are actually going through some early liquidation warning signs after the opening bell, it could be that Citadel's banking activities are done for, because it says that Citadel does not clear its own securities transactions, and a substantial portion of the company's options, clearing and financial activities are with Bank of America. I think it's something like 90 or 95% of all Citadel's transactions are cleared through Bank of America, and if Bank of America does collapse, goodbye Citadel. And that's why I think it's also very important to look at the total number of unrealized losses across the entire banking industry. As Kim tweeted, he said there's $620 billion of unrealized losses on an overall equity value of $2.2 trillion. He said if a run on the banks would happen, it would be as fatal even for several larger US banks like JP Morgan, Citibank, and Bank of America. And Kim said this crisis isn't over, the US Treasury simply just bought some more time. And that's also already being seen in Credit Suisse, because Credit Suisse's credit default swaps just hit a new all-time high. You can see down here Credit Suisse's credit default swaps in 2008, which hit a high of 250 points. Obviously back in November and December, that went as high, I think, as just above 400 points. But right now it's already setting a new all-time high at 446 points, just as Credit Suisse's stock is hitting a new all-time low. So it seems a bank run on Credit Suisse is still very much in the picture, as is a bank run on tons of other banks. Finally, what I'm hoping this ends in is some actual bankers going to jail, just like we've seen in the 1MDB case. As Pick tweeted, they said the former Goldman Sachs banker, Roger Ng, has been sentenced to 10 years in the 1MDB corruption case. Hopefully that ends up with Ken Griffin or a number of these senior bankers also going to jail for what's currently happening in the markets right now. We know there's tons and tons of fraud, we know many of these banks are on the edge of collapse, and it also means that many of these market makers are stuck right now and cannot pass the can. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!